All right, big tech doing everything they can to boost the market, but the rest of the stocks doing their best to drag it down. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick. And look who the horse drew again.
I am here. I'm back again. And I'm Katie Greifeld in for Alex Steele. Thrilled to be here. It's nice to see you.
I know. It's been a long time.
It's been a couple of months. Let's get to the closing bell and what's going on right now in the market, because it's interesting. Even though we have the two problem children out of the way, Boeing and Tesla, you're not seeing much love for the big benchmark right now. The S&P 500 down to the tune of about 0.2%. It's slightly better if you take a look at big tech, but only slightly, because you take a look at the NASDAQ 100 right now, it's pretty much unchanged on the day. Of course, we are counting down to some big earnings after the bell, which, of course, Romaine will get to. Let's take a look at the small cap index just for fun. This is your laggard today. The Russell 2000 currently off by about 0.7%. So those small companies not really doing too hot today. And let's take a look at the bond market. That 5-year yield, it's actually a bit higher right now, about 4 basis points. Of course, we had an auction earlier today at 1 p.m. Wasn't too well received after yesterday's blockbuster, so yields a bit higher, Romaine.
Yeah, yields a bit higher here on the day, but we go back to the equity markets and really kind of a tale of two markets, if you will, with big tech actually logging some pretty decent gains led by Tesla, Apple, and Texas Instruments. In fact, one of the biggest boosts to the market today is actually coming from those chip stocks, which as a group entered a technical correction last week. Now they're clawing back some of those losses this week, rallying almost 6% over 3 days. Richard Clode, a fund manager over at Janus Henderson, he told Bloomberg earlier he actually sees early green shoots in that space really appearing in a lot of those pockets of the chip industry that had gotten particularly hit hard. Texas Instruments having its best day going back to 2022. They gave a revenue forecast last night that did indicate that slump in demand may be easing. And the Dutch chip equipment maker ASM International rallied 11% after reporting strong quarterly order intake. But not everyone is on board with the latest rally in the tech space there. UBS strategists say the sustained performance of the chip sector has now led to decade-high premiums, and that prompted a downgrade of tech-heavy markets in Taiwan and South Korea down to neutral. But here's the rub. They upgraded the MSCI China index to overweight. Now, that's a rare boost in sentiment for that market this year, amid signs that there is a pickup in consumption and the possibility that hoard of household savings that Chinese households have been holding on to will finally start to flow back into the economy. That call, part of a rotation that we've been seeing back into China stocks as allocations tick up for the second month in a row. Goldman Sachs strategists even more bullish, saying onshore Chinese shares have the potential to climb about 20%, partly on the back of support from the Chinese government. All right, well, the renewed optimism there, and even here in the U.S., could get another boost later today, Katie, with the latest spate of earnings after the bell tonight, including from the social media giant Meta. $36 billion in advertising revenue is what they're expected to have generated last quarter. Are you ready?
I am so ready. They asked me if I wanted to anchor today. I said, with Romaine on Meta earnings, absolutely. Take a look at this chart behind me. Meta has been dominant in the stock market this year, coming off of that year of efficiency. Meta shares currently higher by almost 40% year to date. You take a look, this purple line, this is actually the NASDAQ 100, the big tech benchmark. It's only higher by 4% so far in 2024. So you can see really Meta has really put in a lot of work. You compare that to some of its peers, this doesn't even feel fair. You're taking a look at Snapchat, you're taking a look at Pinterest. You can see we're looking at double-digit losses and then some for both of those social media companies. So the stakes are very high heading into these Meta earnings. And as you can see, there's a lot of daylight between Meta and everyone else.
Absolutely. Here, let's kick things off to the close here on this Wednesday afternoon. A look ahead to what happens after the bell with Shelby McFaddin, senior analyst over at Motley Fool Asset Management. Her research helps us support a lot of the stock decisions that they make over there. And Shelby, I do want to start off with big tech and particularly with Meta and whether you actually find some real value there, considering how far and fast that stock has gone over the last few months.
Absolutely. When we look at a sort of fundamental perspective of what is the quality of the business, then yes, we can find value in the fact that Zuck has absolutely shown up in what we call that say-do ratio, where they say they're going to go ahead and make those cuts and drive that efficiency, and they're starting to do that. They're showing signs of being a mature company. Now, on valuation, we believe that it has clawed back a lot of what it lost in 2022. And so that was something that we capitalized on, was seeing what we felt was something in the business that they could get ahead of the pack. There was that potential that they really ran ahead of the group with those early AI investments, and that is starting to show a bit. It's imperfect, but it is showing. So valuation's still a little bit frothy, but overall.
So when you say showing, I mean, you're actually seeing some of that benefit? I mean, because it's been kind of difficult to get a read as to where all this money has gone in terms of the money spent and whether that's actually translated into revenue growth and, more importantly, profit growth. I mean, we know what Zuck is doing. We've seen the AI pictures of him looking cool for a once in his lifetime here. But does that actually contribute to the bottom line?
Sure. So, well, I wouldn't necessarily lead with saying that it's been, clear up front to the T, every single investment. What I would say is they were much better positioned when it came time to show that they might actually have something to work with, when investors were saying, so, generative AI, what's your plan? They didn't have to go and build out a new business unit. They had already started some of that investment. They did need to curtail some of that investment because some of it was leading down to paths of nowhere, but they did still have that sort of foundation that other companies have had to build out. So we saw that Ask Meta launch this week, a little bit weak, maybe not as well as they expected it to go, but having that foundation definitely sets them ahead of some of the other peers that are not only trying to get a hold of chips, but trying to figure out quite what they want to do with them.
Well, you talk about paths of investment that kind of led to nowhere. Should we talk about the metaverse? Do you remember, of course, when Meta rebranded and made a huge splash? Now you really don't hear much about it. It's a company really leaning full force into AI. I mean, is that something when you're listening to the analyst calls, of course, the earnings call coming up this afternoon, that you want to hear about?
I think in some ways it can be a good sign that we don't hear as much about it, because that it does mean that management has been upfront and stern about saying this is behind us now. Now that doesn't mean that the bill doesn't come due, right? So they did have to sort of bear the grunt of any of those share price declines and sort of any loss of confidence from investors. But in some ways it means that they have been able to go ahead and recoup what they did lose and move forward. So I think in some ways it is positive. I think it's something that's not as much brought up because what is lost on those projects. And so the question is, have they committed to leaving that sort of, a little bit less fruitful investment behind? And so far that's been yes. And are they committed to being more efficient? And so far that's been yes. So I think it only gets brought up if they revert to their old path.
Yeah, and I always wonder, maybe they should have waited to change the name, but that's a different point. But when you think about how the stock has performed, as we showed, up nearly 40% year to date, then you compare it to other social media companies, it's just, we're having two different conversations. Should we still be thinking about Meta? Should investors be thinking about Meta as a social media company, or is this just another tech AI play?
Well, what's interesting is that when we think about the social media companies, we're essentially thinking about advertising companies, right? It's something that it doesn't seem so obvious at first, but when we think, how do they drive revenue on these free products? And why is it that digital advertising, consumer reports, consumer sentiment, how is that linked to how these social media companies are performing? And it's because of the ad revenue. And so what we're seeing is that the sort of universe and the conglomerate of platforms that Meta had developed earlier on, they're now able to leverage them across generations. They're able to go ahead and work with various brands and companies to really finely tune where they're sending their ads. I mean, it is becoming incredibly targeted. And so when you've had that sort of foundation just building up, it does set you apart from other social media companies. So they are looking more and more like an ad business, but that's what social media is meant to be. Who can run the best ads?
Absolutely. And of course, the majority of their business right now still in that ad space. Shelby, great conversation. Shelby McFaddin, senior analyst over at Motley Full Asset Management, helping us kick off to the close. And with Meta earnings on deck after the bell, a good excuse to talk about advertising revenue and the evolution of the ad business. A conversation coming up in just a bit with a legend in that space, Lord Maurice Saatchi.
Plus, Speaker Johnson heading to Columbia University to deliver remarks as protests over the Israel-Hamas conflict sweep across college campuses. We'll have the latest.
And of course, we continue our eyes on the market here. In addition to Meta, a fresh slate of earnings from a lot of other big companies as well. That includes Ford, that includes IBM, and it includes Chipotle. Full market coverage coming up here, right on the close on Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Well, tensions on the campus of Columbia University continuing today. This after talks to resolve a standoff between pro-Palestinian demonstrators and officials at the university were extended after the midnight deadline passed. Republican House Speaker Mike Johnson is visiting the school today to deliver remarks and meet with Jewish students. Balance of Power co-host Mathieu joins us now with the latest. And Joe, what is Speaker Johnson trying to accomplish with this visit? Why is he there?
It's a great question. I mean, his office says he's delivering a message here that anti-Semitism should not be accepted on college campuses. But he's going even further to call for Columbia's president to resign. And we've heard that same call from the Republican congressional delegation in the state of New York. Democrats who have also visited the campus have been calling for disciplining students who are found guilty of anti-Semitic behavior. So there's a little bit of a line there. He is apparently going to take some questions. There will be a news conference, remembering that this is a Speaker of the House who's trying to rebuild some goodwill with some conservative members of his Republican conference in the House following this big debate around funding for Ukraine and for Israel. That's also why this is top of mind. He just cleared $20 billion for Israel that the president, Romain, signed today.
Okay, well, good for him. He could have cleared that months ago. I am curious. This is a long way from Washington, Columbia University, right here in Manhattan, New York. It's a long way from Louisiana. There are protests going on around the country. Why did he pick Columbia?
Look, that's a great question, and it is really kind of the microcosm of this story. We're seeing University of Southern California, big protests, Yale, of course, but this really has become the spot here in New York. He's going to be bringing a couple of members of the delegation with him, by the way. Congressman D'Esposito, Congresswoman Malliotakis will be with him, both Republicans from New York. But he's getting criticism here, Romain, for showing up at all. The heavy hand of the Speaker of the House showing up at a private institution, suggesting how they do their business. Will there be an answer from Washington? Is this about legislation? I don't have an answer for you on that, beyond the fact that he's going to get on the news tonight talking on this campus. So there's a lot of messaging going on here. I'm not sure anything about policy.
Well, he's not, of course, the only politician to visit Columbia. I know that you spoke to Representative Kathy Manning, who visited the campus on Monday. What did you learn there?
Yeah, she described a pretty scary scene. She, along with other members of the House, visited the campus Monday and Tuesday. They spoke with Jewish students who described being intimidated, who talked about a hostile environment. Of course, they've gone to hybrid classes as a result of all of this. But one thing she pointed to was the great concern as she walked around that campus of the risers that are being erected right now for the soon-to-be-held graduation ceremony. Guys, that's May 15th. And there are great concerns about what's going to happen, what security is going to look like, not just on Columbia's campus, but campuses all over the country this spring. It's something to think about as we go through the next couple of weeks.
All right. Well, all right. Joe Mathieu, down our co-host of Balance of Power, closer look there at some of the protests going on here in New York at Columbia University, and be remiss in not pointing out these protests also going on around the country. Coming up here, Bank of America affirming its positive view on Apple, calling it a top pick for 2024. We're going to get some analysis on just why. That's coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Molson Coors. Citi downgrading to sell and cutting the price target to a street low $56 a share. The analyst says early April industry data suggesting sales and volume trends for the company's beer brands have turned negative. That would actually follow a record year when the beer maker benefited from the marketing controversy around its competitors' Bud Light brand. The shares, nevertheless, pretty much unchanged on the day. Next up, let's take a look at Airbnb, an upgrade today to buy over at Mizuho. Analyst James Lee a bit giddy about the potential launch of sponsored listings on the peer-to-peer travel platform. He says it could drive double-digit EBITDA upside in the long term. That's in addition to the share gains expected short-term from the Summer Olympics in Paris. Those shares moving fractionally higher on the day. And finally, let's take a look at Supermicro Computer, a sector weight rating over at KeyBank Capital, which starts coverage with an eye on the IT company benefiting from secular AI growth trends. Analyst Tom Blakely says one of the factors holding him back from a buy equivalent view is because Supermicro has a bit of a lack of visibility right now into supply and demand metrics. Nevertheless, the phenomenal run you can see for this stock trading at $7.51, giving back just about 1.5% on the day. And those are some of our top calls. Now, we do want to stay in the tech space, stay in the sell side space as well, and take a look at Apple. They don't report earnings for another week here, but the shares have actually gotten a pretty decent boost over the last few days as investors gear up for that earnings report. Analysts over at Bank of America, they actually say Apple is a top pick for 2024 and expect strong revenue and margin growth when it reports. Wamsi Mohan joining us right now. He's a hardware analyst at Bank of America, and he has a buy rating on the shares. All right, Wamsi, I want to kind of push forward to what the catalyst is because there's been so much obsession over iPhone numbers and whether we're going to see this big drop based on the numbers we're getting out of China. But Apple's got a bunch of events coming up over the course of the year, and I'm wondering how much those events, if at all, have already been priced into the stock.
No, thanks for having me. Good afternoon. Look, I really don't think any of it is really priced in. What we've seen so far is a fairly negative reaction in the stock on a relative basis, an absolute basis. And this has really come on the heels of some of the concerns, both with, Europe DMA, DOJ investigation. You've got the DOJ investigation against Google. You've got so many things going on top of the data points that you mentioned that were coming out of China as well. I would just like to remind everyone that Apple reported back in January, and they knew what China was looking like. They had a month of data. And from what we track, we actually see the China data points actually improving month over month as well. So we actually think that relative to guidance, Apple is going to beat its quarter. The guidance could be a little bit softer for the June quarter, but that's not really where we want to focus. What we want to focus on is this upcoming notion of a much stronger cycle that's going to be driven really by generative AI at the edge for the iPhone as a device, where you know that Apple has the best information of everyone on their phones.
Why don't you think, Wamsi, we have not heard much more of an articulation by Apple executives about that AI strategy? I mean, we've heard from every other major tech company. They talk about it ad nauseum, but you don't hear as much about it from Tim Cook and his executives.
Yeah, absolutely. Look, I mean, I think that we've actually heard them say that they will say something about AI, which in itself is atypical, right? Apple really does not talk about products that are very close to launch ahead of time, like the Vision Pro, for example, or even the next iPhone, right? They don't we know it's coming, but in some ways the executives never really address the elephant in the room, which is the amount of money that's really being spent on developing and the number of years that are being spent on developing some of these incredible products, right? So some of these products have a 4 or 5 year cadence of development. To bring out an iPhone every year takes, a significant amount of effort. So I think it's very much in line with their policy of not getting too ahead of their skis. They don't like to kind of pre-announce what's coming. We will see a preview of it at the developer conference. I think that'll be our first view really into what they can do with AI. I think they'll hold back some information really for the September launch. That's kind of their playbook. They want to keep the excitement going around the products. They want to keep the suspense about what's coming down the road, which gets users definitely much more excited about what's coming down the road than if you actually knew everything about all their intentions, right? And we don't know really, when you think about it from a product cadence perspective, what's next out there. We think silicon development, as far as our checks go, that's a major deal for Apple, both on what they're doing on the hardware side, from product hardware, replacing the modem and internalizing that, to AI chips for servers and regular CPUs for servers. We think that's in the pipeline as well. So there's a lot that they don't talk about, but at the same time, we know that that's all in the works and going to come.
Let's talk about the iPhone a little bit more, because what could be exciting is a cheaper iPhone. Actually, Mark Gurman writing recently in his Power On newsletter that Apple needs a true low-end iPhone to revive growth here. And you think about the upgrade cycle and how expensive iPhones are and weakening demand. I mean, could you see that as a possibility?
So we wouldn't count on that just yet, right? Like, I think Apple has plenty of avenues for growth. One of the key things that Apple does not want to do is really dilute its brand value. I mean, can Apple do a low-end iPhone? Absolutely. Would it dilute the brand value? I mean, where are we seeing Apple products getting sold, and what are the price points of this? In every end market that you've seen, whether it be phone, whether it be in tablets, whether it be in Macs, the Vision Pro, premium products, products that have excellent quality, maybe better feature functionality. The residual value of these products is significantly higher too, which is part of the reason that you can buy an iPhone and trade it back for a significant amount of value that discounts the next purchase, right? So moving down is really not been what their strategy has so far, right? Will they need to do that someday? Yes. But is the market large enough today for them to address, beyond iPhone, other areas of growth? And what can those be, right? So when you think about healthcare as an opportunity, they could monetize that on services. Advertising is an opportunity. They can monetize that on services. Maybe they'll still do something on autonomous, right? Like, so there's a lot of different things where they can go and drive growth over time. Right. That doesn't necessarily mean that they need to dilute current brand value and go down the road of like really cutting price on existing products or introducing something that's very outside their brand.
So, of course, Apple reporting next week. Before we get there, we do have IBM reporting after the bell. I know you cover them as well. Just in about 45 seconds, what are you expecting to see?
Yeah, I would say that, look, the focus is really on AI. It's on consulting. You've had other peers that have reported relatively soft numbers. It'd be great to get an update from them on sort of what they're seeing from a macroeconomic trend perspective. We actually think that the company is extremely well positioned in some of these areas, has really been outgrowing and outperforming peers. So from our standpoint, we actually like the setup very much so, because next year we're also going into a mainframe cycle. And from what we know in speaking with the company, we have visibility of about $12 billion in free cash flow this year, growing into next year, and then further increasing beyond that. Right. So with those tailwinds, we really see a nice runway for the shares.
All right, Wamsi, great conversation. Really appreciate your time. Our thanks to Wamsi Mohan over at Bank of America. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. And it's pretty quiet on the benchmarks, even though Tesla up 12%, not doing too much.
Yeah, that was certainly a surprise that we got last night. It'll be interesting to see if we get another surprise tonight, as another big cap tech company is set to report, and that is Meta. And that gives us an excuse to really talk about advertising, because let's face it, that's where they make most of their money. And that is an industry that relies heavily on those big tech companies like Meta, like TikTok, like Snap to generate that revenue. Our next guest is a legend in this space and has seen it evolve over decades. He co-founded one of the most prominent advertising firms in the world, and of course also served in the government over there in the UK. Lord Maurice Saatchi of the House of Lords joins us now from West Sussex. He has a new book out called O that aims to excite the reader with entertaining and thought-provoking takes on how to expand your mind. Lord Saatchi, great to have you here on the program. As I'm sure you know, this book and its title, which we shortened, by the way, is very provocative. But as you read through it, there's quite a bit in there about, I guess, just not being a stick in the mud, just learning to kind of live life and, more importantly, to embrace things as they come. Why did you write this book?
Well, I wrote this book because, as everyone knows, a physical orgasm is the most blissful human experience. The book makes the startling claim that there is another type of orgasm which has nothing to do with sex, and is even more pleasurable, which is an orgasm of the mind. And that's what this book is about.
I think what intrigued me about the premise of the book, as well as the way you presented it, and anyone who buys this, you should know, just the whole setup of it is not what you would expect here. You are a legend in the advertising space, which to all intents and purposes is a thought business. It's a creative business. It's about getting to human psychology in a way that's going to benefit your clients here. So how do you transfer that decades of experience there into what you're talking about in this book? Is there a direct link?
Well, I don't know if there's a direct link other than the question of whether anything is true or is a lie. And I think what this book explores is that I present 21 popular lies. These are the things people say. They're well known and well accepted. And then I present my version of the truth. And then the reader is able to consider contradictory views and determine for themselves what's true or what's a lie.
I am curious, though, Lord Saatchi. Sorry to interrupt, but before you get on that, because with regards to the sort of popular lies, and you sort of use this idea of sort of blending truth and I guess what most of us would call fiction, but one of the first things you have on there is the popular lie is that the truth is good. I don't get that. Why?
Yes, because, there are the 21 popular lies. The first one, which is perhaps one of the most controversial, is that truth is good. Well, the difficulty with that is that the book almost makes the claim that there is no such thing as truth at all. In that, for example, let's try this. I'm taking a piece of paper. You can see it.
Yes.
I'm going to drop the paper now. It's going to fall to the ground. Tomorrow, the sun will rise. These are statements which we can make, perhaps without finality, but with a certain degree of probability. However, when we consider the general world, let's talk about the political world. In the world of politics, when we express opinions or beliefs or offer explanations or descriptions or observations, then error, doubt, and uncertainty come to the fore. And what this book, I hope, will help people to do is that through the contradictions between the truth and the lies presented in this book, one will follow what I believe is called the Socratic dialogue, which is the method that is the most revered in the world for achieving self-knowledge, wisdom, truth, the truth for you. And that's what this book attempts to do. And by the way, if you want me to, shall I go on for a minute?
You can keep going on. I'm raptured by this.
Okay, well, I mean, here's why this might be important. And obviously, all authors will say, oh, well, my book is terribly topical and very important. Everyone would say that. But I think there is, if I might make this claim, both in Britain and America, we have general elections this year. And in both countries, we consider ourselves to be the ultimate expression of the most basic Western belief in democracy. One man, one vote. And yet, I think you might agree, in both countries, America and Britain, there is a general sense of disillusionment, disappointment with what our democratic system has provided for us.
Yeah.
So I'm making my claim on behalf of this book, Orgasm, that an orgasm of the mind is the only escape route from this world of fake news and alternative facts, which is the world we live.
That's a bold statement. And I do want to kind of tie that back, though, to your career in advertising. And forgive me if this sounds harsh or even critical of your business, but to a large degree, the advertising business is a business of lies. It's a business of at least trying to paint a truth that may be true to you or true to your clients, but to most of us, as we find out as we get older and crankier, that it was all, just a bunch of what. When you look at go ahead.
I'll put it as strongly as I can. Here is supposed to be something which is a statement of truth. It's in the form of a syllogism. Here it is. I'll give it to you. Here it is. Pruning roses is good. I prune roses. I am good. But that fails because the premise, pruning roses is good, is open to objection by people who prefer leggy, straggly roses with few blooms. So even there in that example, which could as well be an example from the political world or the business world or any world, that even in that absolutely most simple, straightforward example, it is possible to argue that the statement is not true. Now, whether in the natural sciences, I don't know whether many scientists are watching the program, but even in the natural sciences, the scientists, I think, would agree with me that even though something appears to be totally proven, such as tomorrow the sun will rise, even that statement cannot itself be proved beyond doubt. So when it comes to making political statements, your hope, your chance of being able to determine the difference between a truth and a lie is enormous. So, for example, shall I give you one of the examples from the book which I think might be relevant to your viewers? One of the popular lies is that big companies are wonderful.
Right.
Well, the book takes exception to that and argues that big companies might be even worse than big government. Now, this is a very major statement indeed.
Yeah.
But the book goes on to explain that what has happened is, in terms of free markets and free market competition, which all your viewers watching now believe in, that what has happened to free markets is something which has made believers in free markets feel very uncomfortable, which is that there's been an unintended consequence of globalization, which is the creation of giant cartels, of giant global companies.
Yeah.
And that I'm not talking about tech companies, I'm talking about all companies.
Right.
And that has meant that there is a huge imbalance of power between the giant global corporation and the individual customer.
Right.
And this is not at all what was intended by the concept of the free market. It's not at all what believers in the free market would like to see. But nevertheless, that is what's happened. And Mrs. Thatcher, tremendous heroic figure in my life, would be very disappointed to see that the end result of competition is the end of competition. And that, for example, even more horrifically, that Karl Marx might have been right. Because he predicted, didn't he?
Yeah.
That after years of internecine warfare amongst capitalists, there would be fewer and fewer capitalists controlling vaster and vaster empires.
And isn't that kind of where we are right now, though? I mean, this is probably one of the more fascinating parts of the book, aside from some of the other Socratic stuff that you started off with. And I wish we had more time to talk. I mean, we could talk for an hour here, but I've got, producers and directors waving at me saying that, we should have gone to commercial like 10 minutes ago. So, Lord Saatchi, I'm just going to leave it there for right now. We're going to catch up again. You're in New York soon, promoting this book. Lord Maurice Saatchi of the House of Lords, a legend in the advertising space, and he's got a new book out, that is currently on sale. We'll be back. This is Bloomberg. All right, time now for our stock of the hour, and we got multiples for you with a fresh slate of earnings results expected after the bell. Meta, Chipotle, IBM, Whirlpool, Ford, and quite a few others expected to cross the wire in just about 15 minutes' time. Abigail Doolittle joining us right now for a walkthrough of what to expect. Where do you want to start, Abigail?
Well, let's focus in on tech, because of course we have Tesla out of the way, out of the woods, up sharply after a horrible quarter, but that optimism around the cheap EV. But of course, after the bell today, we have Meta. Growth is the name of the game. They're looking for 63% growth for the bottom line. That's like real growth from back in the day for technology. $4.44 per share, 26% growth for the top line, $36.1 billion in revenue. That is what's estimated right now. So it looks like the year of efficiency, which I think was last year, or maybe it was 20. I don't know. It's hard to know when it was. Yeah, it feels like it was forever ago.
You don't remember that? You're not going to tell your grandkids about the year of efficiency?
Yeah, no, I probably will not be. Well, first I have to have children, but or in any case, the year of efficiency is paid off to some degree. Plus, AI algos are really helping. But the thing that on Meta, it's a real high bar, a lot of pressure, up 133% over the last year. So they really have to deliver. And then Microsoft and Google Google tomorrow. Double-digit growth for Microsoft on both top and bottom line. Azure, their cloud product, 80% better sequentially. So that's really pretty good. And then we'll also be looking for the AI influence there. And then Google, 5% a decline of 5% on the top line, and then 28% growth on the bottom. So margins doing pretty well there. Core search, it's interesting. We kind of forget about that because we're hearing about AI, cloud. That's estimated at 11%, but some are saying that the cloud could be strong too for Alphabet.
Yeah, absolutely here. And it was interesting. We had an analyst on yesterday who was talking about Microsoft, and she just kept banging the drum on Azure.
On Azure, was she talking about that 20%?
Yeah, which is
growth?
kind of interesting that because I feel like a lot of people have kind of forgotten about that.
Yes.
Moved on to the shiny objects. Abigail Doolittle with a closer look here at what to expect. Some of the big tech earnings tonight and tomorrow as well. We will have full coverage, of course, of Meta earnings when it crosses the wire after the bell tonight. As we continue to count you down to these closing bells, Katie Greifeld, when you take a look at the broader market going on right now, not a whole lot. Probably the biggest, most exciting action right now is in the transport space.
The most exciting moment will be the after-hours trade, of course, when we get through some of these earnings. Probably much more exciting than what we're seeing right now.
All right, stick with us. Katie Greifeld, I think, is going to stick with us after that last interview. Let's hope so. Saira Malik going to be joining us in just a second, Chief Investment Officer at Nuveen. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick alongside Katie Greifeld filling in today for Alex Steele. About 10 minutes until we get to those closing bells, Katie, and a bit of a turnaround from what we saw the last couple of trading sessions.
Yeah, a little bit. I mean, you take a look at the S&P 500 right now. It's not down, but it's unchanged, of course, coming off of 3 straight weeks of losses into this week, a consequential week. We don't have much to show for it yet, even though, of course, we did have Boeing and we had Tesla, but the real biggies start tonight.
Yeah, Meta platforms. Are you still using Meta?
I do.
Or have you moved
I
on?
use the Messenger.
I mean, I know you were an X person. And are you still on X?
I'm still on X.
You're one of those people?
I wish that was
Okay.
a public company.
You wish it was a public, do you?
I really do. I would love to take a peek at those financials. But you can see big tech, even with Tesla out of the way, only up about 0.4%. That obviously is the index to watch.
All right, we're going to talk a little bit during the break about Katie Greifeld's social media choices. In the meantime, let's get back to the markets as we count you down to the close with Saira Malik, Chief Investment Officer over at Nuveen. And Saira, which first of all, pleased to have you in person here in Studio 2 in New York. But let's start off with the earnings because this is a big week for earnings, as you might have heard here. We got a little bit of a boost yesterday from Tesla. We get Meta tonight, and of course, Google and Microsoft later this week here. Have what we've seen so far, has it lived up to expectations?
Well, it's great to see you.
Yeah.
I mean, this market kicked off this week with a relief rally going into the biggest week of earnings. And today, it's turned into hesitation. It's the biggest week for mega cap tech. Expectations are for about 38% earnings growth year over year. That's a high hurdle. Just starting with Meta, which has been the second best performing mega cap tech stock year to date behind NVIDIA, it's a high hurdle. They guided to faster revenue growth this year. Last quarter, whispers are for 30% revenue growth. They need to meet that or exceed that, I think, for the stock to continue to move higher from here.
I'm curious, if we don't see those growth numbers, I mean, there's been a lot of talk about year of efficiency, improving margins, improving the bottom line. If the growth numbers don't live up to expectations, but let's say they beat on some of those profitability metrics, will that be enough to save us?
Given what the stock's done year to date, I'm not sure that it will be enough. Definitely, it has been an efficiency story for them, but now people want to see that growth in there from Reels, from monetization, also from advertising. I think they need to have that there for the stock because it's just got a lot in the stock already. It's been such a great stock this year and last year.
Like you said, there's a lot of good news in the stock already, up almost 40% this year, and that's after the year of efficiency. I don't know what this year is going to be, but how are you thinking about valuation? Because you could look at the stock price and say, wow, again, a lot of good news. But then you take a look at the valuation. It's trading, I think, 23 times earnings or something, and there's a lot of other companies, a lot of other peers trading well beyond that.
Yeah, I mean, valuation is not super expensive for Meta, but it is a fairly consensus stock at this point with a lot of people crowding into it. I think, from our point of view, Amazon looks more attractive to us. That's a company there with AWS and also the investments that they made during the pandemic in their logistics. We think Amazon has a little more juice from here going forward.
All right, so Amazon, of course, one to watch. And I mean, outside of big tech, you take a look at just the broader indexes. And we're coming off, like I said, 3 weeks of losses. When you think about what's been driving the sell-off, do you think that anything fundamentally has changed, or is this really rate-driven at this point?
I think it's been rate driven, and also the battle of the bull versus the bears is around two factors, and that's what's the economy doing and what's inflation doing. And we're going to get two data points this week on both of those. Tomorrow, GDP, which should moderate a bit from where it's been recently, but still very strong at 2.5%. So I think that's going to be fine. But at the end of the week, we're getting PCE data. That's where we might run into a hiccup. About a little over 2.7%. If we hit 3%, I think that's going to be negative for the markets. We're watching areas such as financial services, which should be pretty strong because it's based on the rally from March that we saw in the markets. Also, healthcare is going to be hot in PCE. And finally, goods prices with electronics coming in with prices up this quarter to date. I think all of that likely leads PCE to beat numbers, and that might be finally what takes a little steam out of the earnings-based rally that we've seen.
So then that feeds into, obviously, inflation expectations and, more importantly, Fed rate expectations. But those expectations, at least in the market, are basically at zero now, at least, about as statistically close as you can get. I don't know what more the Fed and, more importantly, the economic data can show that would suggest that the Fed really doesn't have the argument to make for rate cuts this year.
Yeah, we've been pretty consistent. Our Global Investment Committee never went above 3 rate cuts for this year, and I would, at this point, take the under on that. I think the market got over-optimistic when it went to 7 rate cuts at the beginning of this year, and now I think we're down to maybe 2 rate cuts, even less than that. The Fed tends to do less during an election year, not more. So as that election approaches, I think that the Fed is less likely to do anything. So maybe you get a rate cut around fall and then one more in December. But if inflation's sticky, and I think when all is said and done, PCE this year, inflation, it'll still be above 2%. The Fed may not feel the need to do anything. They're just going to be patient. There's no need for them to preemptively cut rates if inflation is not down to the levels that they think it should be.
Is there, though, everything that you just said, and you put that against the backdrop of where you allocate money, is there a case to be made in this environment for cyclical stocks, rate-sensitive stocks, those basically the more economically driven stocks out there?
As long as the economy remains strong, which it has because of employment and the consumer, it can start to broaden out. So there is a case to be made for some of these lagging stocks like energy and materials, which had some of the worst earnings expectations coming into this quarter. I think those companies can start to perform well. Also, outside of equities, fixed income, where you can lock in some strong yields in segments of fixed income, and then alternatives such as infrastructure stocks, where they tend to be less cyclical than the economy. So for those who are worried that we will eventually see this recession, you can look at these less cyclical areas like infrastructure.
Let's talk about fixed income a little bit more. Are you talking about treasuries, or are you talking about corporate bonds there and really getting sector specific?
One of our favorite areas of fixed income is municipal bonds. The fundamentals remain very strong because of how strong the economy in the states have been. Their rainy day funds are high, their savings rates are high, and in high yield municipal bonds, you can capture yields in the high single digits. But this is, a once in a multi-year, even multi-decade opportunity for municipal bonds. Also during tax season, munis tend to sell off a little bit, so that is a nice time to enter into that segment.
That's really interesting. That's a big call. What, once in a decade or something? What have the flows look like into municipal bonds? Is that a known opportunity at this point?
It's interesting. Year to date, the flows have been positive into municipal bonds. So people are starting to recognize that this is a good buying opportunity for that asset class.
Saira, always wonderful to talk to you, and great to have you here in person in New York. Saira Malik, Chief Investment Officer over at Nuveen, helping us count down to those closing bells. We're just about 3 minutes to go until those bells. And of course, not a lot in terms of the price action, but that could change in a big way once those earnings start to hit.
I'll say it again, the after-hours session is going to be more interesting than the actual normal market hours. We did get some action when it comes from Tesla, a double-digit gain on the day. Boeing was interesting, too. You're not seeing it in the big benchmarks necessarily. I guess that speaks to Tesla's diminished role at this point.
Tesla's diminished role here. And I thought it was interesting, too. What did you make of just how severe that uptick was? Because there were no details. It's basically like, look, we're going to make a pivot. We'll be fine. I guess if you believe Elon, then you buy.
You had Ross Gerber on yesterday, right, saying that you
I was kind of surprised. He seemed a little less enthusiastic. He's still back in Tesla, but he seemed a little less enthusiastic than
maybe a little
change
of heart there.
All right, well, stick with us here. Ford, Meta, Chipotle, Whirlpool, just some of the names on tap to report earnings after we get to those bells as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with Tim Stenovic and Carol Massar. Welcome to our audiences across all of our Bloomberg platforms here on another busy earning day. But unlike yesterday, Carol, unlike Monday, the price action in the market decidedly different.
It feels so tortured today. I feel like the back and forth that we're seeing in the equity averages, right? Little change at this point. Not the conviction that we saw certainly earlier in the week. And I think that's a good point. Does some of the earnings, does Meta Platforms change that potentially? I guess we'll have to wait and see, and we'll find out in a few minutes.
I did think, at least earlier in the session, Tesla and the rebound that we saw in Tesla stock today after yesterday's report, which, by the way, wasn't good, would set the tone for today's trade. But that certainly hasn't happened. And, make no mistake, everyone's just sitting back waiting for Meta Platforms to report in a couple minutes.
Yeah, that's the thing, that even though there were some single stock specific stories coming off of earnings that definitely you saw some movement there, you really had to look under the hood to find the action. Of course, all of this is going to change in a couple minutes when we get those earnings finally. But a quiet day, definitely a wait and see sort of day.
Yeah, definitely a wait and see kind of day. And it gets to the question here as to what the market is really looking for. Are they looking for better earnings growth? Are they looking for better profitability? Or is this still about the Fed and economic conditions?
Well, that's a really good point. Liz Ann Saunders over at Charles Schwab, we just talked to her, and she says it's not really about the speculation of what the Fed will do, how many rate cuts. It's really about yields, what we are seeing in reality along the Treasury curves. That's really in the driver's seat and impacting the equity trade.
All right, we get the closing bells here in New York. Let's get you through the numbers real quick before those earnings hit. The Dow Jones Industrial Average relatively unchanged on the day. It takes a while for these numbers to settle, but right now we're down about 30-something points on the day, or about 0.1%. The S&P 500 higher by about 2 points, a fraction of a percent, while the NASDAQ Composite higher by 16 points, or 0.1%. I do want to point out two big downdrafts that we saw today. The Russell 2000 down 0.4%, but a huge drop in the Dow Transports, down more than 2, and that was on the back of some bad earnings out of Old Dominion Freight.
All right, some good perspective there. Hey, in terms of the S&P 500, just digging into it broadly, 279 names to the upside in today's trade. Katie, 222 to the downside, 2 unchanged.
And you take a look at the sector level, taking it a step further. Of the 11 sectors, you had 7 in the green, you had 4 in the red. You look at what did well today, it was consumer staples. That sector up about 0.9%. You had utilities, consumer discretionary also rallying as well. You take a look at what was left out of the action, and to the downside, you had industrials leading losses down about 0.8%. Healthcare and financials, too, not having too great of a day, but small moves overall, Carol.
All right, get to some of the individual gainers, and Tesla atop that list of the NASDAQ 100 and the S&P, number one, that one gaining about 12% in today's session. We know what it was all about, guys. Even though the quarter wasn't so great, the big excitement about Tesla saying, yep, we're going to accelerate the launch of less expensive cars, and that certainly got everybody excited. So again, Tesla shares up about 12% in today's session. Texas Instruments, another standout performer, had to do with earnings, up 5.6%. Top name in the NASDAQ 100, its biggest gain in about 4 years. Company's revenue forecast indicated a slump in demand may be easing, giving a lift earlier in the session to the overall chip sector. And really quickly, a name that popped up among the biggest gainers in both the NASDAQ 100 and the S&P 500, CoStar Group. This one was up just shy of 9%, just off its highs of the days. And this one, again, up the most in more than a year and a half. It's an online real estate service company, reported first quarter results, beat expectations, and also raising the low end of its full year revenue forecast. So really some outperformance in those names.
Okay, let's talk about some of the decliners very briefly before we do get earnings from Meta. I want to start with a name that Romaine just mentioned, down 11%, Old Dominion Freight. Worst single day in nearly 2 years. Shares falling after the company's first quarter revenue only slightly lagged the average analyst estimates, but certainly sent some shockwaves throughout the sector today. Also, shares of Boeing falling, reaching a new 52-week low. Shares were up pre-market after the company reported earnings. First quarter adjusted cash burn of $3.93 billion was smaller than the estimated $4.4 billion, though it did move lower in the day as the day went on. And then just before 2 p.m., Moody's Ratings downgraded Boeing's credit score to 1 notch from junk as quality control issues weigh on the company's free cash flow. And I did also just want to take a look at what Meta Platform shares did today. Stock up nearly 40% so far this year, but finished they down by about 0.5 percentage point, underperforming the broader indices. The company is expected to report revenue growth of 26% for the first quarter. And And then the company's also expected to report revenue of $36.12 billion, the vast majority, of course, of that being advertising revenue at $35.57 billion.
Let's check in on yields here. This was a busy week for auctions, and while not all of them went well, the overall net effect of it is modest changes that we're seeing across the Treasury curve. You did see modest losses on the longer end of the curve. That pushed yields higher on the 10, the 20, and the 30-year yield by roughly about 4 to 5 basis points. Your 2-year yield, though, down ever so slightly by just about a point.
Yeah. So, I think what we should do is just talk a little bit about Meta at this point, because we are awaiting, obviously, that's the big one in the after hours. And we were talking to our Mandeep Singh, just kind of the role of AI and helping this company among its platforms really in ad targeting. Because I said to him, is AI really, really moving the needle financially on the balance sheet? And said, yeah, it is. And it is specifically when it comes to ad targeting. And so these are things to watch for as this company gets ready to report.
Well, think about all the negative sentiment around the stock 3 or 4 years ago when Apple made those IDFA changes, the idea that it wasn't going to let apps have the data that it previously had. Meta Platforms was able to pivot and adjust by using AI to better target those ads and better target content to its users to get people to use the app more and spend more time on it.
Well, I'm glad you brought that up, because I remember all the agita over that here.
It was
all you got to do is really you go into the Bloomberg terminal and you look at that trajectory of revenue growth. Now, they did have a few bumps at the end of, was it late 2022, where they had a couple of those down quarters with a negative sign in front of it. But all told, the amount of revenue that they're generating, $40 billion in the most recent quarter, in the fourth quarter, I should say, and the numbers that we're about to get today, if you believe analyst estimates, are going to come in around $36 billion. That's well above, $10 billion above where we were just a couple of years ago.
Yeah, it's quite a turnaround story. And remember, last quarter, they initiated that dividend, which really speaks to this is a mature company now that they feel comfortable enough that they actually are starting to give back cash back to shareholders. I mean, those are some of the stories that I'm interested in, because I really took that as a signal.
It's also a company that's up, 194% last year, and then again up about 40 this year. They are crossing. Romain, you want to kick it off?
Absolutely. Meta Platforms crossing the wire right now. Let's walk you through the numbers here. For the first quarter here, the company's seeing adjusted revenue coming in at about $35.6 billion. That's slightly above street estimates of $35.6. EPS coming in at $4.71 a share. The street on average was looking for $4.30. Here's your guidance for the second quarter. The company sees revenue of $36.5 billion to $39 billion. Now, the top end of that range of $39 billion is just ever so slightly higher than the average of street estimates, which was for $38.2 billion. You see the share reaction there, down about 9% here, but there's a lot more in this release, guys. Jump in when you see it.
Yeah, perhaps that's why shares are lower, is because when it comes to the second quarter revenue expectation, it is, just slightly above at the top end, the consensus. I do want to note that the family of apps revenue for the first quarter did come in quite a bit above estimates, about $500 million above estimates at $36 billion versus estimates of $35.53. And then there was the operating loss from first quarter Reality Labs, which came in below estimates. It was expected to lose $4.5 billion. It only lost $3.85 billion.
But even still, I mean, you take a look at expensive, even with that more narrow than expected loss when it came to Reality Labs, full year total expenses between $96 billion to $99 billion. Previously, that had been seen between $94 billion to $99 billion. So, Carol, I'm not good at math, but that is a bigger range and a higher range.
And that's the commentary that certainly, like you are, catching my attention. So it says, as you said, full year 2024 total expenses range of 96 to 99, up from 94 to 99 due to higher infrastructure and legal costs. They also say we anticipate our full year 2024 CapEx will be in the range of 35 to 40, increased from a prior range of 30 to 37 billion, as they continue to accelerate their infrastructure investments to support artificial intelligence roadmap at the company. So again, spending more, expenses are more. I think that's got to be catching attention by investors.
And they say that's going to extend well beyond 2024.
Yep. Hey, you guys keep checking out Meta Platforms. I'm looking at Ford right now. The company sees first quarter adjusted earnings per share above estimates at 49 cents. Estimates were for 42 cents. We're seeing shares in the after hours move higher by 3% as we speak. Ford still sees fiscal year adjusted EBIT of $10 billion to $12 billion. Estimates were for $10.45 billion, Romain.
All right. I just want to just bring you some news coming on IBM. We were expecting to get their earnings. Their earnings haven't crossed yet, but they have. actually now confirm what Bloomberg has been reporting, that deal to buy HashiCorp. They say they are going to use cash on hand. It's about $35 a share. Based on Bloomberg estimates, that would value this deal at around $6 billion. Again, we're still looking for the actual earnings results, but they are confirming that they are going to buy HashiCorp with the cash on hand. Actually, now, Katie, we are getting the rest of those numbers on IBM.
Yeah, you see that IBM first quarter revenue coming in at $14.46 billion. That is versus $14.25 billion year over year. When it comes to their cash flow, they still see full year free cash flow at about $12 billion. You take a look at what shares are doing right now, and they're tanking, Carol, currently down almost 6%.
Yeah, this is kind of interesting. I mean, something we've been looking about is some of their consulting under focus. This is a big company that certainly consults a lot of other companies. We saw Accenture slump, so we're going to look for some more insight into that. But yeah, you're looking at shares of IBM down about 5% in the aftermarket. And a quick check on Meta, if I may, as we head out, guys, we're seeing that stock down about 10% in the aftermarket. So a big hit certainly to that name. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place, tomorrow.
And our earnings coverage continues right here on Bloomberg Television. The earnings crossing fast and furious, including Ford. Those shares higher here in after hours trading. Meta, though, sinking as much as 12% here. Co-host of Bloomberg Technology program, Ed Ludlow, joining us right now to talk a little bit more about what we learned. And Ed, on the surface here, at least for the most recent quarter, the numbers were in line to slightly above estimates. The guidance slightly in line to above estimates, but maybe some concerns here about how much they're going to have to spend going forward on those AI projects.
Yeah, that's a pretty good summary, Romain. Like, the first quarter was strong, and the stock is down 10.5%, pretty much only on the 2Q guide for revenue. Really high expectations for Meta because of all the hype around them with AI. But particularly on what they're guiding us on the second quarter revenue number, there's a 1% headwind from foreign currency. And I'm pretty sure that when you go on the call in about an hour's time, they'll use the words tough comps and talk about how the same period a year ago is difficult. But things are very elevated. You know, Zuckerberg's really talking up AI story, Meta AI, and also the latest model, Llama 3. I would also say that they're damned if they do, damned if they don't, right? The street has been really frustrated with Meta's spending, and then other corners of the market are saying, please spend more on AI. So look at the expenses number for the full year, and look at the CapEx number for the full year. They're raising those because of the infrastructure spend on AI, but there's also some additional legal costs in there as well.
Yeah, I mean, you take a look at the total expenses number. They see between $96 billion to $99 billion. They saw between $94 billion to $99 billion. It seems like investors, they're happy to accept big spending if it's on AI, but maybe not necessarily when it comes to some of the other projects that Meta has underway. And I'm talking about, for example, the metaverse.
Yeah, and on the expenses, they're just raising the bottom end of that range. But that just shows they're more committed to a bit of spending. You know, the big question is, where does this return on investment show up? You know, Mandeep Singh of Bloomberg Intelligence is like zeroed in on ad targeting, but we need a specific number to reference. And so I would ask you guys, look at the ad pricing growth. I think it was around 6% in the quarter. Impressions across all of their properties up 20% year on year. There is some argument that AI is making the ads better at targeting specific audiences, and that's helping them sell at a higher value. We have a new phrase. Romain, you're going to love this one. It's DAP.
Yeah.
DAP. DAP.
DAP.
Daily active people.
Oh.
It's the new metric
Daily active people.
that we DAP. So let's DAP it. And
I know what DAP, Ed, my people invented DAP, by the way. I don't know. Zuckerberg's rebranding it as something else. Daily active people. Isn't that pretty much everyone on Earth?
Zuckerberg is going through a big rebrand himself right now as well. Right. So I don't know if this is intentional, but that number is basically for all the users of all platforms, and they're seeing some solid growth there too. It just takes getting used to, is my point.
Yeah, that might be an understatement. Ed Ludlow, always appreciate him jumping on these earnings days. We're going to get back to Meta in just a second, but we do want to dive into some of the other big reports that are out. Ford, those shares higher in after hours, trading up about 4%. Adjusted EPS beating estimates at 49 cents a share. Total revenue beating estimates at roughly about $43 billion, and the company standing behind its full year forecast. John Lawler joining us right now, the chief financial officer over at Ford. And John, on the surface, these numbers look pretty good. As you know, still a lot of questions and concerns about cost cutting. How much more should investors expect?
Well, we had a really solid quarter. And, we didn't expand our guidance range of adjusted EBIT between 10 and 12 billion, but we have indicated that our trajectory is towards the high end of that guidance. So, it looks like we're on track for a really solid year this year.
I'd be remiss in not asking you about a lot of the concerns right now going on in the EV space. The Model E business at Ford was at least the worst performing of the major businesses. We got earnings out of a couple of your competitors, including GM and Tesla. And at least on the EV side, things weren't much better. Do you see any hope of improvement in that business this year?
Well, we're segmented, so we're different than many of our competitors, at least the traditional OEMs. So you have the transparency about where we're at with our electric vehicle business relative to our commercial business and our internal combustion engine business. So you have the transparency. Look, we know that we need to have the electric business stand on its own. It needs to be profitable. It needs to provide a return on the invested capital, and we're working diligently to get there. And we have a lot of hopes, and we know that our second generation of vehicles that will be coming out in a couple of years are going to be a big step forward and bring us to the point where we will be profitable. So we won't launch them if we're not profitable. So, we've got to make the best of it through this period here until we get to the second generation vehicles, and we'll continue to manage that and optimize across the company.
Well, John, I mean, hypothetically speaking, what would it take for you to maybe say, okay, we're going to make this segment much smaller than it was? We know that EV adoption has been really slowing down and really below what a lot of people, especially the automakers, had expected. How committed are you to the EV space when you look 5-10 years out?
Well, look, EVs, it's not a matter of if, it's a matter of how fast. They are the future. We will be going there. The industry will be going there. It's just, I don't think we should question that. It's the pace of change and the pace of adoption. And so we're going to right size in the near term to match our capacity and the investments to where the consumer is. And then we'll accelerate as the consumer accelerates. But make no mistake that EVs are important because they're a big part of what all automotive companies need to do to meet compliance for greenhouse gases and zero emission vehicles. So they're a big part of what we all need to do to hit those compliance regulation requirements that we have.
Let's talk about the price tag, because I think a lot of consumers, in addition to maybe some range anxieties, the perception is that EVs are a lot more expensive than what I could get from some of those traditional engines. So when it comes to your plans for that $25,000 more affordable EV, it seems like it's going to take until late 2026. Why is it going to take that long to develop?
Well, it's a completely new platform, and it's a new way and a new approach of how you develop a vehicle. We have a team out in California, we call it our Skunk Works team, individuals that have designed EVs, successful EVs, profitable EVs with other companies are there. It's a whole new approach. It's a brand new ground up platform, and they're taking, they're taking those learnings and they're applying it here. And it takes a couple years to develop a complex vehicle like that, and that's what they're doing.
All right. Well, there's a lot of work certainly to do on the EV side. I am curious, John, if you can talk a little bit about the commercial line that you have over there, Ford Pro, that unit that appeared to be kind of the standout in the most recent quarter. What exactly is driving that? And more importantly, John, is any of that going to be transferable to the consumer side of the business?
Well, it's an incredible business in Ford Pro. We have moats from our products. We have moats from the fact that we provide software services that help our commercial customers improve productivity and uptime, and it makes their business stronger. And the learnings that we have there are transferable to the retail side, and we're doing that today, especially around service and the conveniences that we've learned about from the commercial customers. So it's a really strong business. We've talked about it being a strong business, and we've talked about the earnings potential, and I think you see that clearly in the first quarter with a print of adjusted EBIT of $3 billion.
And that gets to this idea, too, because, I mean, when you look at some of the features that go into a lot of the commercial vehicles, and the idea that at some point, at least when the cost is feasible, that could transfer there. There's been a lot of discussion here about Ford kind of upping its software game, basically getting beyond just obviously what you do best, which is the actual building of the cars themselves. When it comes to the software and the tech side of this here, have you done hiring in that space? Have you done any sort of attempt to actually beef up that business, if you will? I know it's not technically a standalone business, but you know what I mean.
Yeah. Absolutely. Over the last few years, we've been hiring. We've been bringing in experts from the outside, consumer product software experts, et cetera. And that's a real big part of what we've seen with the Ford Pro story. If you look at it over the last 12 months, about 13% of their EBITs come from software and physical services, and we expect that to grow to 20% of their adjusted EBIT in a few years. So we have a team in place. We have a great team we've recruited from the outside with some folks that we had inside, building out those services that our pro customers love because it makes them more productive. It improves their business.
And I also want to talk about some of your other models, specifically your gas-powered models. I'm thinking about the Bronco, for example. I'm thinking about the Maverick, in addition to the F-150s. But I feel like I've seen so many Broncos on the road. How are you thinking about output levels in those areas, again, those gas-powered vehicles?
Well, we have incredible brands across our company between F-Series, Bronco, Mustang, you name it. And demand's very strong. Demand's very strong for all of those vehicles. So we're meeting that demand. We're continuing to produce. We're working on, getting as much out of our factories as we can, and you see that in our results. We just launched the brand new F-150 in the first quarter here. It's now selling very well. So there's a lot of upside there in the Blue business through the rest of the year.
All right, John, really appreciate your time today. On the heels of that earnings release, our thanks, of course, to John Lawler. He is Ford's Chief Financial Officer. For Ford shares currently up about 3-4% or so. Now, coming up, we're going to get back to those results from Meta and speak with Angelo Zino, Senior Analyst over at CFRA. This is Bloomberg. Well, let's get back to our top story, and that's Meta out with their latest results. Joining us now to help break it down is Angelo Zino. He is Senior Analyst over at CFRA. You take a look at what the market thinks, and it's not good. Meta shares currently off by more than 12% after hours. What do you think is the big worry right now? Is it that revenue outlook, or is it that big increase, of course, to CapEx and to expenditures?
Yeah, I mean, listen, I think first off, the actual quarter looked pretty good in my view. I mean, you kind of look at the top line growing about north of 27%. That's a good number for them. They're probably going to be, when you kind of look at the rest of the kind of competitors out there, they're probably by far going to outgrow everybody else on the digital ad side of things. But when you kind of look at the guide here for Q2 on the revenue side of things, definitely a little bit of a disappointment, but we do think the bigger disappointment is really on the OPEX numbers. When you look at Meta and why they've been able to kind of see the momentum they've been able to see here over the last 5 to 6 quarters, a big reason for it has really kind of been able to keep those cost controls really tight as they've seen an acceleration on the top line. Everybody already knew that growth was going to start to decelerate as we progress through into Q2 and more importantly, the second half of the year on some of those more difficult comps. But the expectation, I think, from most was that they were going to keep those costs in check. And the fact that we're actually not seeing that, I think, is definitely spooking a lot of investors out there.
Angelo, it sounds like what you're saying is that the year of efficiency is over and that apparently traders don't like it.
Yeah, I mean, I'd go as far as that. I mean, it's definitely a disappointment, I think, for traders out there. And it is definitely an end of an era in terms of kind of those cost controls that we've seen from the company. And the question now is, what is the company going to say on the call as far as the expectations going into not only into the second half of the year, but more into 2025? What kind of commentary do they throw out there? Do they alleviate some of the concerns that we're seeing right now or not?
I am curious. I mean, I know there's a big focus on the costs and obviously the amount of CapEx and spending that they're going to do on AI. But just talk a little bit about their traditional business, which is still just this defiant cash cow, the advertising business. We're in an election year already, which typically tends to benefit advertisers. There's been a lot of discussion about how a TikTok ban or divestiture might actually help some of the other social media platforms, like Meta's platforms, et cetera, here. Do you see growth continuing in that ad space, kind of unfettered?
I mean, we do. I mean, we actually think AI, if anything, is kind of, helped kind of the growth trajectory for the digital ad space out there. You're absolutely right. I mean, Meta is kind of, in many respects, unlike other of the kind of Mag 7 names. They're more of a one-trick pony out there, in that they're really kind of completely tethered to that digital ad space right now. Our view is it'll be able to kind of grow at a low double through 2025. And, AI will definitely kind of help them in that respect. We've seen share gain on Meta's side of things here in recent memory because they've been able to act and move so quickly with some of their AI initiatives out there, kind of creating some of those great, ad creation tools for some of those advertisers out there that will continue to kind of gain momentum, we think, over the next couple of quarters. That should help their overall business and kind of the growth trajectory for the digital ad space. But, I mean, in all respect, I mean, again, the comps do get a lot more difficult as you get into the second half of this year.
Yeah.
And, of course, as you get into 2025 and lap these type of numbers that you're seeing right now.
I am curious, though, long term about the user base for Meta. There's been a lot of hay made over, I guess, the age of some of their users now, particularly on Facebook, but even Instagram. And I could just tell you with the kids in my family, none of them mention any Meta properties. It's all, Snap and Discord and, some of the TikTok and things like that here. Do they have a generation problem that they're going to have to confront at some point?
I do think there's an issue to an extent from that side of things. I mean, I think they've been able to see some improvement with Reels kind of here over the last kind of couple of quarters. And, there are more and more, I think, individuals out there kind of, going towards that Instagram platform on the Gen Z side of things. But I think you make a valid point. I think when you kind of look at some of the more kind of next Gen Z population out there, it is all kind of TikTok, it's Snap out there. But, I think, when we kind of think about, Meta here, they are starting to kind of, find a way here with Reels. I think there are going to be other kind of tools out there that they throw that could potentially kind of help improve that ecosystem. And then we also do have to see what happens with TikTok here over the next year or so that could potentially help their business, improve engagement levels and what have you. So I think you make somewhat of a valid point. But that said, I think they're still in a good place.
All right. Always love talking to you. Angelo, Zino over at CFRA. A quick analysis on those Meta earnings. Investors pushing the shares, Katie, down about 12% here, and that's also dragging down Pinterest, Snap, and Alphabet.
And, of course, the Qs, of course, that ETF that tracks all these big names, QQQ, currently down 1% after hours, really feeling the effects of Meta.
Absolutely. Here, also seeing IBM kind of oscillate between gains and losses. IBM shares right now down about 6% after their earnings just came up. When we come back, we're actually going to take a look back at the dawn of the personal computer era and a milestone entry into that market by IBM. This is Bloomberg. All right, time for this day in history and a look back at April 24th, 1981. That's when International Business Machines introduced a basic input-output system that would underpin its first ever true personal computer, the IBM 5150. Now, while IBM's PC was far from an industry first, the company's version set a standard for the use case, pricing, and underlying technology that to this day still permeate almost every brand of computer on the market. Remember, prior to 1981, it was possible to buy a PC, but there really wasn't much point. Those so-called personal machines, they were heavy, 50 pounds or more, expensive, $7,000 to $10,000 would cost you, and had almost no software applications at all that would appeal to the average consumer. But by April 1981, a secretive team of IBM engineers had sequestered themselves down in Boca Raton, Florida, more than 1,200 miles away from the ivory tower of IBM's headquarters in upstate New York. The goal was simple: speed development for a small computer that would sell for just $1,500, but still have the same power of some of those big mainframes. So in August 1981, they finally had something to show for their effort. IBM executive Don Estridge, he demonstrated the completed PC at New York's Waldorf Hotel. They were able to keep the price at only $1,565 by using cheaper off-the-shelf parts like Intel chips and Microsoft's MS-DOS system. The computer had 16 kilobytes of RAM and came with two applications, the spreadsheet program VisiCalc and the word processor Easy Writer. A disk drive and a display, well, that was sold separately. It was an immediate hit. The company estimated it would sell 250,000 units over 5 years. It sold that amount in less than one. 2 years later, CEO John Opel made the cover of Time magazine, and sales were so strong that IBM made its now $9 billion personal computer operation a separate unit. But the PC business proved to be a fickle beast. Almost since its inception, the IBM PC unit was on a roller coaster, reversing periodic slides, winning back market share, only to suffer even deeper drops. And by 2004, just a little more than 2 decades after the formal launch, IBM threw in the towel on personal computers, selling off the business for just $1.25 billion to an up-and-coming Chinese company called Lenovo. It was symbolic of the shift already underway of technology manufacturing moving to Asia. And while it ended one era for the century-old IBM, it did usher in a new era, with IBM concentrating its growth strategy around software and consulting services, 2 businesses that combined now account for at least 70% of the company's revenue.
And of course, it's a real full circle moment because a number of companies, they're out with earnings in the last couple of minutes, including IBM. And here to help take us through all of the action, all of the results, we have Bloomberg's Isabel Lee, Bailey Lipschultz, and Alexandra Semenova. Isabel, kick us off.
Thanks, Katie. Speaking of IBM, what a great story from Romain. And IBM shares are edging lower by 7%. And investors are largely reacting to the disappointing consulting arm of IBM, which is continuing to see a weak demand. So let's take a step back first. IBM gained 1% in revenue to $14.5 billion. And IBM also reiterated its previous outlook of around $12 billion in free cash flow. So going back to that consulting business, it was unchanged compared to the previous quarter. Revenue came at just $5.2 billion. So investors were really reacting to that, and they weren't really liking what they're seeing. But the next big news came after market hours, with IBM officially announcing that it is acquiring software firm HashiCorp. So this represents an enterprise value of $6.4 billion because they will be buying it for $35 a share. We've been hearing chatter about this for the past couple of days, and now they officially announced it. And even before this official announcement, we have Bloomberg Intelligence saying that this could be a step in the right direction for HashiCorp, and William Blair saying that this deal makes strategic sense. So for context, IBM's largest acquisition, it was in 2019 with Red Hat at $34 billion. But for now, investors are not liking what they're seeing. But year to date, IBM is up around 13%. What about you, Bailey? What do you got?
Yeah, Isabel, keeping an eye on ServiceNow, software provider, has been riding the AI wave down about 5%. That's in line with what analysts and earnings had been baking in for the move. But this is all coming off of underwhelming or slightly underwhelming guidance for subscriptions in the second quarter, falling just shy of what analysts were looking for and keeping their eyes on the entire full year expectations for subscriptions, which account for more than 95% of those sales. They're keeping expectations for second quarter to between $2.525 billion and $2.53 billion, falling slightly short of what analysts were looking for at $2.54 billion. So disappointing outlook for subscriptions in 2Q, maintaining that guidance for full year, even though earnings and revenue both beat this year in the first quarter. Big thing to keep an eye on. This is another company up some 86% in 2023, had been rallying to start the year again, talking up Gen AI. CEO leaning into the fact that some of those subscriptions related to artificial intelligence are booming, but right now stock down 5%, giving back some of those gains, but on an intraday basis would open really kind of where it was at this point late Friday. Alex, talking Chipotle?
Hey, Bailey. Well, beats across the board for Chipotle Mexican Grill. Quarterly earnings, revenue, and same-store sales growth all topped Wall Street estimates. Comparable sales rose 7% above the average analyst estimate of 5.13%. Adjusted earnings per share came in at $13.37 per share. That's above the $11.60 per share that Wall Street had expected. And people kept buying burritos this quarter. Foot traffic increased 5.4%. The company also sees 2024 comparable sales growth in the mid to high single digits. Chipotle has been one of few restaurant chains to still see transactions grow even as it's raised its prices. You can see shares moving here up more than 3% after the close. The stock was up about 28% this year. Romain, Katie.
All right, great stuff out of Alex, Bailey, and Isabel. A nice roundup of some of the big earnings out there. And we do want to go back to, of course, the biggest of them all, and that is Meta. Those shares really taking it hard here after its latest results. A beat on some metrics, but a lot of concern right now about how much money it's going to have to spend to chase those AI dreams. Jeremy Bryan joining us right now, portfolio manager over at Gradient Investments. And Jeremy, is the price move that we're seeing here in after-hours trading, does that feel like an overreaction to you?
Early part, yes. But here's the thing is it's worked incredibly well. And the reason why it has is because they were getting rational on spending, right? Is that metaverse spending was, looked at more of a side project. People, investors like me, wanted more of the AI spending and a little bit more cost rationalization on that. And that looks like where it's going here now. But anytime you see cost increases along with revenue, that guidance that was a little bit light of expectations, I think that's the bigger thing here is are they back on the flywheel of spend greater than we expect?
Yeah, I am curious. I mean, you are an investor in Meta, so obviously there's something here that you like. And this has been a company that I think has been counted out multiple times and has always managed to sort of bounce back up and show just why it's the beast that it is. I mean, and we should just point out, Jeremy, I mean, we're still talking $36 billion in ad revenue. I mean, it's just untouched. I mean, who comes close to that other than Alphabet here? As a long-term investment here, do you have enough confidence in the vision that Zuckerberg has, and more importantly, his ability to execute on that vision?
Yeah, because they have among the most valuable things on the planet, which is data on a lot of consumer spending and just consumer behavior in general. And if you're thinking about artificial intelligence and where it can be most leveraged, it's in that area. That's why exactly we own the stock is for that opportunity over a longer period of time. Mr. Zuckerberg has done a good job in history about taking advantage of that scale and that opportunity through either acquisition like Instagram or through building their own enhancements to products like Reels. So in that regard, I just think they have good shots at goal for taking advantage of the things that AI is probably most advantageous to in the next 3 to 5 years. Knowing its customer base, knowing that leveraging that data and using that data in an AI-based tool would seem to be most valuable. Meta can definitely play in that space.
Well, you bring up Reels, so let's talk about TikTok. Obviously, Meta's answer to TikTok is Reels, and with that in mind, I mean, what would a potential ban of TikTok potentially mean for Meta? Can you even forecast that at this point?
Short answer is no. I can't imagine it's going to terribly hurt them, right? I mean, advertisers have to chase where the eyeballs are. And if the U.S. government says TikTok's eyeballs, you're no longer allowed to watch it, they're going to have to go somewhere else, right? And whether even consumers do that, advertisers are going to have to do that, right? They're going to say, I can't advertise on that platform anymore. I have to spread that advertising spend to someone else. That someone else could definitely be Meta and the Reels platform. So we think it's a benefit. If it actually ends up happening, who knows? We have to kind of keep monitoring and pay attention to it. We have no idea what the end occurrence will be. But at the end of the day, if that were to happen, Meta is probably more of a beneficiary than certainly hurt by it.
All right. Well, Jeremy Bryan, it's great to get your perspective on this day when Meta reported and the market didn't like it. Our thanks to Jeremy Bryan of Gradient Investments.
Yeah, Jeremy's great.
He is great.
I was just looking, though. I just want to point out, I mean, the 12% drop, because I was trying to think, oh, wow, that's huge. But then I was going back. I feel like every earnings day, they have these 10% plus moves. Remember, last earnings season, they rallied 20%. A couple earnings season for that, they dropped something like 20-something%.
It's a volatile stock around earnings, maybe more so than some of their other big tech peers. But right now, if you're a long-term investor, maybe that's an opportunity for you because Meta really feeling the pain right now. But let's talk about some of the other earnings that crossed in the last hour. I want to start with Ford here, actually beating sales estimates on strong demand for their work trucks. We spoke to CFO John Lawler just a couple of minutes ago. He says the company is on track for a really solid year. You can see that maybe traders after hours agree. Shares currently up about 3%. A lot of question marks about EVs, but the core business is very strong. Meanwhile, take a look at ServiceNow, now down about 5% or so. They projected sales growth that fell short of estimates, and you can see that disappointment working through the shares of ServiceNow right now. Much more coming up. This is The Close on Bloomberg.
All right, just a little while ago, we saw a regulatory filing where the music rights investor Concord said it was going to increase its takeover bid for Hipgnosis to $1.51 billion. And that trumps a rival offer from Blackstone made just a few days prior. And it really puts into the spotlight the real battle out there right now over music rights. Of course, a lot of that music not just being played for our own listening pleasure, but it sort of underpins what you see on those social media platforms, whether it's TikTok, whether it's Instagram, or even in the gaming community when you're playing a game like Fortnite. A big player in that space is joining us right now. Her name is Sherrese Clarke Soares. She's the founder and CEO of Harbourview, which has about more than $1 billion in investments in various music properties, including the catalogs of Nelly and Pat Benatar, Wiz Khalifa, and I'm sure I'm forgetting a bunch of others. Sherrese, welcome to the program. And I just want to point out, I mean, this is a relatively new business. I mean, you started this relatively recently, but you've ramped it up pretty fast. You've got some pretty big backing from names like KKR and a few others here. Can you just talk to us right now about why there's so much appetite to buy up the rights to these music catalogs?
Absolutely. Thank you. Thank you so much for having me, Romaine. Well, listen, I think one of the things that is very true about this asset class is its resilience. And, you know, we heard earnings over the last couple of weeks from a lot of the people in the streaming space, but including Spotify, which showed, you know, subscriber growth growing both on their, you know, premium and ad services, ad supported line as well. What that shows you is just really how integral music is into the daily human experience. And when you kind of have that as a core basis, you really do have a non-correlated asset class. It is something that is not impacted by various cycles, but also it's so integral to how we live our lives every single day. So then you add that to the ability to finance this asset class very efficiently, which you've seen in both, you know, the bank markets as well as the bond markets. Mm-hmm. And then you put all that together, it feels like it's a very active space, particularly for scaled assets, as you've seen across a number of different exit opportunities that people have been able to curate over the last couple of years. Yeah. The marketplace has existed for a long time, but certainly it's gotten more institutionalized over the last couple of years.
Well, that's what I want to talk about, because I mean, for those of us who are old enough, we remember, you know, Bowie bonds, we remember the Stones selling off portion of the that was obviously a much different the way it was structured, but it was still kind of the same concept. One thing that is different, though, it seemed like the bands and the artists that were doing that were kind of aging, let's just say. You know, they were kind of at the tail end of their careers. They weren't putting out new music. But when I look at some of the deals you've made and some of the deals your competitors have made, you're making this with artists that are still relatively young, relatively active.
Absolutely. I mean, I think, listen, you know, again, what we've learned over the last decade or so is, again, how integral music is to all these various spaces. And that's not just only the legacy things that we all grew up and love, like Fleetwood Mac, that's a part of our portfolio, but it's also things like Nelly, who's obviously a young person, or things like, you know, Wiz Khalifa, who's obviously a fairly current artist too. So you have the ability to see and to project long tail trends based on behavior and consumer behavior that is now so decentralized, right? We all grew up in a time, you know, in the 80s and 90s, well, I guess I'm probably dating myself, where basically we were told what music to listen to, we were told what shows to listen to by virtue of it all coming through very centralized ports. Now, the way that we listen and engage is very decentralized and then kind of grows and spawns from various, you know, very specific audience engagement. So what that allows for is even younger artists to be thinking about how to create liquidity for themselves, how to create opportunities to use that liquidity to candidly create agency for themselves, to be able to make more empowered decisions about how they manage their career, rather than taking a lot of upfront advances that, you know, wed them to, you know, a certain deal structure, a certain deal type. So we're seeing the liquidity in the market become institutionalized. We're seeing, you know, the capital markets see it as such as well, you know, including the bond market as well as the equity markets. And so we think that that'll only continue to happen. Music is not new, obviously. Music's been around since the beginning of time, but how we consume it continues to be decentralized, and as it becomes decentralized and able to be quantified with data analytics, you can then start to do more around making it even more investable.
I mean, it's a great point when you think about how you find new music nowadays. How you do that is much different than how it was. For example, if a song goes viral on TikTok, it's probably going to find its way to you. But I want to talk about your business and expansion a little bit, your plans there, because last month in March, you raised approximately $500 million through an ABS, a private ABS. Of course, it had backing from KKR. What do you plan to do with that money? What's next for you?
Yeah, so absolutely. So that just continues to expand our firepower to continue to make more investments. It's against an existing pool of assets that we already have. We continue to make investments in the space. We're very active. We just closed another deal yesterday, which we're not free to announce yet, but it just allows us to continue to be active. It also continues to fuel our business. All this capital continues to fuel our business. That's also more than music. Yeah. We're an investment firm that's thematically focused on all things sports, media, and entertainment. And so, it allows us to start thinking about other adjacencies that we think are really interesting and other themes to play in the market right now. And obviously, we see a lot of really interesting spaces to play.
So, Sherrese, I know you can't comment on that deal specifically, but I am curious if you can maybe share some insights into how you sort of pick. I mean, there's just so many artists out there. I mean, how do you sort of say, okay, this is going to be the winner? I mean, what's the process?
Yeah, for us, we are very quantitatively focused. We believe that the art drives the science. We believe very much in the creative process. We are very big believers in the creative ecosystem, and we believe that audience will tell you how they're engaging with music and how they're engaging with what it is that they're looking at. So for us, around new music catalogs, it really is around very highly quantitative engagement around what's happening. And then we kind of come to the artist community with a real understanding of what it is that they're looking to achieve from an economic perspective, but then not only what they're looking to achieve from an economic perspective in this moment, but what they're looking to achieve over the next 10, 15 years of their career. So we try to basically be and hit this middle note, if you will, of being able to think about how to optimally scale these assets, how to optimally finance these assets, but then how do we partner with creators around how they want to drive value to the assets that they find. So it's a long-winded way of saying we do a lot of quantitative work to sort out what we think the risk reward is for us, how that fits into our overall portfolio, but then also how we could be partners to the creators.
All right, we're going to have to leave it there. Sherrese, we're going to have to catch up again. A fascinating person and some fascinating company there. Sherrese Clarke Soares, a career on Wall Street, turning to founding two companies, including Tempo Music and now Harbourview Asset Management. All right, stick with us here. A lot more coming up here on the big program. We're going to set you up for what to watch over the next 24 hours. This is a close on Bloomberg. All right, setting you up for what to watch tomorrow. Economic data coming down the pike. A first look at first quarter U.S. GDP. Anna Wong, Bloomberg Economics chief U.S. economist, joining us right now. And Anna, I think we are expected to see some sort of deceleration from the prior quarter. What are you expecting?
We are expecting a 2.6 quarterly annualized growth for first quarter. So that's pretty solid, especially compared to what everybody was expecting going into this quarter. But that's still, and it's still above the potential growth rate of the economy, which is about 1.6 or 1.7%. So it's a pretty solid number.
And Anna, what do you care more about this week? Is it GDP or is it PCE, which of course follows on Friday?
Right. I think the GDP already gives you a strong hint of what to come on Friday. I think for us and for the Fed, of course, the most important number is the core PCE inflation for March. And we are expecting a 0.3% monthly change in the core PCE inflation, which is also coming in hotter than what most people, including the Fed, would have forecasted early this year.
All right, Anna Wong over at Bloomberg Economics. A nice look ahead to the GDP numbers tomorrow morning, PCE data on Friday morning. Meanwhile, some other events to keep an eye on over the next 24 hours, including the Secretary of State of the U.S. traveling to Shanghai.
Yeah, definitely something to keep in mind as, of course, geopolitical tensions continue to rise across the globe. Of course, staying global, we're also going to be keeping an eye on that Turkey rate decision, that coming at about 7 a.m. New York time.
And at 8:30 a.m. Washington time, we do get those GDP numbers, but a few other data points coming as well as inventories and, of course, those weekly jobless claims.
A lot to look forward to. Of course, all appetizers to PCE on Friday and earnings before and after the bell, Romaine.
I know, before the bell. You got to get in early for that, Katie. Caterpillar, Southwest, Newmont, Hertz, Hetz. Who you got?
Oh, man, I don't know. I am excited to see. Oh, we also have Snap on the board. I mean, it really spans industry, so it should be fun. And also, this is for you. The NFL draft tomorrow. It's not for me.
Who you got? Who's going number one? I know you're a huge football fan.
I wouldn't even know where to start, but I know that Travis Kelce plays for the Chiefs.
Okay, but he's not in the draft.
No, he's not.
All right, nevertheless. And first of all, really appreciate you taking us. It's like, this is fun. It's like old times. And we only had like one horse reference today.
That's true.
So I don't know. Who knows? Maybe we'll get a chance to do this again. As always, really appreciate you watching Bloomberg Markets to Close. We are here every day for you. We'll have full coverage of all of those earnings tomorrow after the bell. In the meantime, stick around. A lot of political news going on out there in the world. Joe Mathieu, Kaylee Lines, up next at the top of the hour with Balance of Power. This is Bloomberg.